The stock market's at an all-time high. Jobs are at an all-time high. Everything's at an all-time high. And we're going to keep it that way. We have the greatest country in the world, and we're back. We're back like nobody thought possible this quickly. I thought it would take maybe a year, maybe 2 years, maybe even 3. And we did it in less than 6 months.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks were mixed on Friday as Wall Street tempered its rate cut hope expectations amid economic data this week that showed higher than expected wholesale inflation and a rise in July retail sales. And stocks were mixed today, very much like this week was. We did see outperformance in communication services through and through Google, Meta, the telecoms, Netflix, as well as healthcare on the back of just a whole bunch of super investors buying health insurers. They're seeing a lot of value in this space, and I do believe that they look pretty cheap on an absolute and relative basis. And we did see a movement into the sector. It just so happens that while they are cheap, it's also a defensive sector, and we did get a need for defensive positioning in some of the economic data we got this week. And I guess you could also see that's why the telecoms were bullish today, and some of the names like Google, Amazon, Microsoft, some of the mega caps are also seen as somewhat defensive, at least in the tech space. Semiconductors took it on the chin after some news we got from Trump. Everything from Nvidia, AVGO, AMD, MU, as well as the equipment manufacturers all took it on the chin. This stemmed off Cisco's earnings as well as Applied Materials earnings, but again, some of the news we'll talk about a little later. It looks like software is putting in a little bit of a bottom right here. They've been hammered over the last couple of weeks after ChatGPT 5's release. We could see infrastructure taking a bit of a bounce. They've been hammered as well, everything except for Oracle and Palantir, and then some of the mega cap names, Apple, Microsoft, JP Morgan, Berkshire, these names took it on the chin, and financials as a whole took it on the chin. You can see these are the winners and the losers here today. Defensives outperformed real estate, healthcare, staples, right? Especially healthcare up 1.68%. And I guess if a sector looks cheap and oversold and you need to rotate defensively, and that is a defensive sector, this is where you're going to go. It just makes logical sense. But we did see, again, outperformance in real estate, staples. And then gold was flat in the context of the S&P 500 falling 0.23%. Energy and materials were also flat, so commodities. Very weird to see two sectors close where they open. And then sectors that detracted from the market today were financials, technology, industrials, utilities, and consumer discretionary. Anything cyclical, anything sensitive really took it on the chin today. But all in all, a fairly bullish week if you ask me. But looking at the day, you could see we saw a rotation here into value. You could see that value, all in all, we saw a rotation into large cap value sectors. That was flat today, as well as mid cap growth. But that being said, mid cap growth could also be considered value relative to large cap. But I guess it's, not value against the other components. But yeah, all in all, a red day through and through. And it stemmed off some of the economic data we got here today. Now, the economic data was actually good. Retail sales came in at 0.5 versus 0.5. But again, this means rate cut expectations do actually move back. Better than expected retail data just coincides with the fact that there could be inflation, right? The consumer's doing a lot better. And why do we need rate cuts? And that's why the market was a bit choppy today. But all in all, good retail sales data. But what's even better was this retail sales control group month over month right here. Look at this, 0.5 against a 0.4 expectation. The control group adjusts for GDP in this nominal retail sales figure. It's a far better barometer and a far more accurate barometer for the consumer. And the consumer looks really healthy if you ask me. You can see we also performed in line if you exclude autos right there. However, Michigan consumer sentiment, which I think is a politicized survey, came in slightly below expectations, but it is a 3-star survey, as you can see with this red mark right here. It's a high impact survey. What did move the market as well was semiconductor tariffs. Donald Trump said he will announce them next week. Now, we do know the ins and outs of this, but the market just sold semiconductors on the fact that, Trump can be very erratic. We saw Nvidia fall 1% on the back of this news. It did put in a low, recover a little bit towards the end of the day, but down 1%. And then United Health really driving a lot of the flows today, up 12% on the back of every super investor on earth buying that after the release of their 13Fs last quarter. And then for everything we saw today, there was 2,600 advances, 3,600 decliners. We saw net inflows in the Nasdaq and the New York Stock Exchange, and then market momentum remained solid. Everything from the 5-day to the 200-day continues to be above the 50% mark. If you're looking for momentum to stall, we are seeing it. Look at yesterday versus today. However, things are still largely healthy, and until this actually turns in a very big way, market momentum will continue as it has, and that is onward and upward. Now, looking at the week that was very, very interesting interesting day of trade, or week of trade, I should say. The worst performers here were actually like gold and Bitcoin, which tend to be inflation hedges. Now, we did get two sets of data. There was a lot of focus on the PPI, which showed hotter than expected inflation data, but you also have to take the fact that the CPI did come in cooler than expected. So we got two sets of data, and so that's why we had very, very mixed and volatile price action here in Bitcoin as well as gold. Equities outperformed, and they were actually positive on the week, mostly led by the broad market. You can see the IWM was up 3%. And again, the reason why we're seeing equities outperform largely has to do with rate cut expectations, especially after that CPI report. Rate cut expectations for September got ramped up in a very big way. In other words, we're definitely getting a rate cut, and that is why we saw stuff like European stocks, IWM, the RSP outperform. But we did see the S&P 500 put in some really good work, up 1%, which is pretty good. 1% in a week. That's a good return. You take that any day of the week. And then the Qs were up 0.3. But yeah, just very weird to see that price action there for gold. What did bonds do? Let's have a look at TLT. So we can see right here, if we go ahead, look at TLT, it was down 1.22% here for the week. Up for the week, I guess, on that inflation data, the CPI report, but after the PPI, we sort of saw lower lows, lower highs into the week. Now, year to date, but Bitcoin, European stocks, and gold continue to outperform, all up in excess of 20%. But US equities also really good, 10% through August. That's a great return. The Q is up 13%. The RSP and IWM up 6 and 2%. So they're probably underperforming what they would do on a usual year. But I mean, most people are indexed just to the S&P 500 itself. There you go, 10% through August. That's a great return and well off the lows. So you could see now, looking at today's trade, we had a red day, as you can see, across the board. Large caps, mid caps, the RSP, the Russell 2000, everything was fairly red, and a pretty brutal day. I mean, down 0.5 percentage point. That is pretty brutal. But again, when you look at the week, we were up for the week, and we were just tempering some of the gains we made early on. Growth underperformed value, so value outperformed. And then European stocks were virtually flat. Middle Eastern stocks and Chinese stocks were up ever so slightly. And then if we actually have a look at crypto, now if we just go here onto the daily chart, not including today's trade, you can see that Bitcoin was down 0.8% yesterday. Ethereum was down 2.37%. But after a massive move, you would expect something like that. Volatility ticked up ever so slightly. Yields continue to rally. And again, on that hotter than expected inflation report, yields are going to do that. And the dollar doing some very weird things. You can see the dollar was down 0.36% today. And as a result, TLT was down 0.7%. And then if we actually have a look at what gold did, gold was down 0.65% on Friday. Silver was down 1.35%. And then crude was actually up 1.62%. I guess it is going to outperform in an inflation heavy environment. Now, guys, next week, what are we expecting for the S&P 500? It's very, very interesting. Now, if we actually just look at the weekly chart, we could see some very, very interesting dynamics. Ultimately, this looks bullish. Why? Because we just put in a new weekly closing high. That's a very, very solid candle, and that's a new weekly all-time high. By the way, I know it's not an intraday all-time high, but we closed at the highest weekly level ever at 64.49. In fact, that's bullish. Now, in the same context of this all-time high, we're putting in higher highs, right, and higher lows at the same time. Very, very solid stuff, and virtually going unabated, like rallying, minor consolidation right here, the tariff tantrum pullback, and then just a blast off from the bottom to those highs. Very minimal consolidation. And ultimately, when you look at this chart, the only thing you can say is in the bullish. Okay, it's just simply bullish. It gets a little bit more bearish when we dive into the daily chart. We can actually see here that we have seen a little bit of volatility along with this bearish engulfing candle, but ultimately buyers bought the dip and rallied all the way up here. But we did see some fairly ugly candles along with a doji right here, and then this, I guess you could say, a bearish engulfing candle, but there's a little bit of buying. It wasn't as deep of a bearish engulfing candle as this right here, but a bearish engulfing candle nonetheless at the top end of the core wall range. I think ultimately next week, everything is going to move on two things. The Jackson Hole performance, Jerome Powell is speaking, just to see where the Fed stands with the data right now. The market's going to move on that, right? And then the second, and I think most important thing, is going to be Nvidia's earnings. That's also going to move the market, particularly for the S&P 500 and the Nasdaq 100. Not so much for the smaller names. The smaller names are going to move as rates move. So you want to keep a close eye on the 2-year, 10-year, and 30-year yield, right? If these continue to tick up, that's going to weigh on equities as a whole. But if the 10-year yield, right, if the 10-year yield, like let's say this is the high right here, and it continues to just move on this downtrend that we've been in for a while, equities are going to really, really like that. Looking at the 2-year yield, it's at 3.75%. So the market is still telling you that it's looking for about 75 basis points, potentially 50 basis points, a worth of rate cuts here for this market. That's what the 2-year yield is telling us. But if this continues to tick higher, and that could be tempered down to as much as 25. And ultimately, right, the market is going to be looking at September's FOMC. That if we get a rate cut there, it means more cuts are on the table. But if the September cut gets pushed forward, that's really going to hurt equities, particularly these small cap names. Now, when we look at some of the other indices, right, the S&P 500 making all-time highs, the Nasdaq 100 making all-time highs, there's a little bit of risk to this market is when you look at something like the RSP, right? I guess you could say that's an all-time high right there, but really just trading flat. We can also see with the Russell 2000 trading flat, nowhere near its highs, same with the mid-cap indices right here, as well as the S&P 600 indices. So ultimately, what you want to look for, guys, is we sort of want to go notching all-time highs or new 52-week highs in the context of the S&P 500 and the Nasdaq 100 doing the same. If that is the case, it just shows that market breadth is expanding. But if the S&P 500 continues to make new highs, and then stuff like the RSP continues to just trade sideways, nowhere near its highs, that is a little bit concerning with regards to market breadth. But ultimately, right, equity market technicals look really, really good. And when you look at the broad S&P 500 earnings, and when you look at the earnings picture for the S&P 500, things look really, really good. Even the Russell 2000, it's looking at pretty solid earnings. I think it's like 63% earnings growth this earnings season so far. So very, very solid stuff in the Russell 2000. And that is obviously going to support equity valuations going forward into year end, along with rate cuts if we do get those, because then you have to re-rate the cost of capital. And that's highly favorable for equities and a continued move to the upside into the end of the year, especially if we get that cut in September, and then look to see what more cuts we will get into the end of the year. Now, looking at Ethereum, right, we could see here that as of recording this, Ethereum is slightly up, but we did see a little bit of a pullback here towards the end of the week. But ultimately, Ethereum is just doing what it has been doing for the last couple of months, and that we had a rally here, consolidate. We had a rally, consolidate. We've had a rally. Now, I think we're just going to do a little bit of consolidation. The big concern I have right now when it comes to Ethereum is that, we could be making a lower high here at these all-time highs, and we didn't go ahead and notch those all-time highs. So what we need to do is if we pull back, it needs to be a short, sweet, and shallow pullback. And then we just need to continue the move higher here for Ethereum into those all-time highs. That's what needs to happen. If we start drifting, into these levels right here below this line, if we start drifting right here, that does open up some of these ugly areas into Ethereum. So the Ethereum bulls need to pull it together very, very quickly. I mean, we could pull back as far as this yellow line right here, which would still mean another 10% to the downside. Yes, this cryptocurrency is very high beta, high risk, right? But you can actually pull to this level right here, find support, and then go from there onward and upward. But we want to make a new all-time high, probably, I would say, before the end of this month. Is about 14, 15 days before the end of this month. We want a new all-time high in Ethereum. Because September and October tend to be fairly choppy months seasonally for Ethereum as well as Bitcoin. Bitcoin, we do know that M2 money supply continues to tell us we're going to move higher. Bitcoin looks actually constructive here. I mean, yeah, we made a new all-time high. The pullback's been fairly orderly. I think we find support here and then continue to move. I'm bullish on both Bitcoin and Ethereum. There's no love lost between these two assets in my eyes. Now, all in all, guys, next week, everything's going to be moving on NVIDIA earnings. I think market technicals and what Jerome Powell has to say. Ultimately, everything's going to come down to what are the rate cut expectations. If the market starts to sniff out that we might only get 25 basis points of cuts this year, we may stall. But if the market starts to pricing more, if we get in economic data that can support rate cut hopes, markets will continue their momentum onward and upward. Guys, I'm diving into sentiment. This is the fear and greed index. And while the market is pushing to fresh weekly all-time highs and sentiment sitting in greed, this just reflects the strong bullish momentum we're seeing, as well as resilient risk appetite. And while it's not peak euphoria here in extreme greed, it shows investors are still leaning into this rally, which does raise the risk of froth if momentum continues. However, the technicals for the equity market look really, really good, and you don't really want to take the other side of the rally, especially when we are in overbought or greed territory. Things can go on for a lot longer than you think, and the technicals are good, but so too are the fundamentals. When you look at earnings, this earnings season for Q2, 13.2% earnings growth. This is why we're actually rallying, right? The earnings, as been incredible. We were looking for 5.2% this earnings season. We're coming at 13.2%, a massive beat right there. Revenues beating, margins are beating, 80% of companies reporting above the analyst expectation. Absolutely insane. And again, earnings led by comm services, technology, financials, healthcare, the big sectors. But where does this leave us with valuations? And when we look at valuations, things do look a little bit frothy. When you look at US valuations 22 times forward, the earnings does support that, does look a little bit frothy, and margins also support that. But things do look a little bit frothy. However, the PE ratio itself can give you tunnel vision. When you actually adjust for growth and look at the PEG, stuff like tech, stuff like Mag 7s don't really look that expensive. In fact, if you look at it in totality, they actually look relatively cheap compared to some other sectors like staples, healthcare, or discretionary, despite looking expensive on a PE basis. So, is the market expensive? By definition, yes. Is this a reason to sell? Probably not, because again, the fundamentals look good and the macro also looking really good. We got the latest estimate of the Fed's Q3 estimate, the GDP now, and that's at 2.5%. Very solid stuff. The estimates you can see right here, the blue chip consensus estimates was for below 1%. So if this number does materialize, that is just more upside for the equity market. However, there is risks in the macro right now. PPI came in hot, but one thing that nobody is talking about is that the PPI was driven by services, and there was an increase in general services costs and in the trade component, i.e. that's wholesale and retail margins. The general belief is that businesses will eat the tariffs and margins will shrink. The data or the trade component is not telling us that. It's telling us that producers are not eating the tariffs. In other words, it's likely getting passed on to consumers. And that is what we're actually seeing. You can see goods is actually having a little bit of inflation here, especially in recent months, while services is in disinflation. And that's not going to be a good look. Often PPI does lead CPI. So the inflation data is going to be the key data point we're going to look for over the next couple of months. It used to be the labor market data. Now everything is back on the eye of inflation. Now looking next week, we don't really have any inflation data, but the big data points are going to be around housing. Building permits, housing starts, and existing home sales are occurring on Tuesday and Thursday. We also get the FOMC minutes, but lately the FOMC minutes has been a non-event, but a big event is Jerome Powell speaking. And then I do believe week after next is Jackson Hole. So this is going to be a really strong read through as to what the Fed board is thinking. Earnings next week, actually a pretty big week of earnings. We kick it off with PDD and Williams Sonoma before the open. We'll probably cover PDD on Monday. Then we get Baba, right? So a couple of Chinese names here earlier on in the week. And then we get Okta, MongoDB, and Quantum. We'll probably look at Okta or MongoDB. And then Wednesday, a very big week here on Wednesday. We have Chewy, Abercrombie Fitch before the open. Coles as well, KSS ticker symbol. And after the close, we get the big one. NVIDIA is reporting their earnings along with CrowdStrike, two very big names. And then we also have Snowflake, HPQ, Iris Energy, Iron. That's a retail favorite name right there. Viva, Trip.com. So a lot of big names, but more specifically NVIDIA here after the close on Wednesday. And Thursday, we have Dell Technologies, Lulu, Marvell after the close. Let's have Best Buy and Dollar General here before the open. So this is going to tell us how the consumer is holding up. These stocks have done very well this year. So a lot of consumer names here on Thursday with Best Buy, Dollar General, Lululemon, Affirm, Ulta Beauty, right? We also get Central One, Autodesk, Webull. I might cover Webull as well. We might cover Dell. Probably cover Webull because I do own a very small stake in the stock. And then there's nothing on Friday, guys. But if you made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and we'll comment for the algorithm. Cheers.